75 years ago, as war raged in Europe and Japan, delegates from all over the world gathered in Bretton Woods, New Hampshire, to build a new global financial system. Through their creativity and collaboration, billions were lifted out of poverty all over the world, and the American middle class was created. But nearly a century later, it's time to recognize that the global economy has changed. We need a new system, one that builds on what worked, free markets and free people, and changes what doesn't. We need a new path for the future of capitalism, so countries can heal fractures within their own economies. From excessive inequality to job loss from technology, we need to win the race for the future of money. The rise of digital currencies, the long-term health of the euro and the dollar. We need to harness all the tools of economic statecraft, from using sanctions and trade policy wisely to reining in financial crime. Most of all, we need to remember what they knew in 1945. Economics, finance, and foreign policy are all part of the same story. This is a time to restore and rebuild America's collaborative economic leadership. This is a time for geoeconomics.
Good morning. I'm Josh Lipsky, the director of the Geoeconomics Center at the Atlantic Council. And thank you everyone for joining today. We've had so much interest in this event, and I think we can understand why. We have an extraordinarily important topic, and we have fantastic speakers to help lead us through this conversation. So we all know the situation that we came out of in 2020, the worst year for global economic growth since World War II. Over 100 million people around the world lost jobs. Over 250 million people lost working hours. But 2021 brings some hope. Vaccines, recovery. The problem, of course, is that the hope is not evenly distributed. Some countries and regions are poised to do much better than others. And that's what we're going to talk about today. We're going to take a tour of the landscape starting in the US, going around the world, and looking at the global economy in 2021. I'm honored to be joined in this conversation this morning by Jan Hatzius, Chief Economist at Goldman Sachs, and Catherine Mann, Global Chief Economist at Citi and former Chief Economist of the OECD. Couldn't ask for two better speakers for this conversation. So we want you to join in this conversation with us. Use the Q&A function on Zoom if you're watching here. If you're on social media watching, use hashtag #FutureOfEcon. I want to thank our board members who are present today, Kostas Pantzopoulos, Ambassador Borden Gray, and everyone who supports the Geoeconomics Center. So let's get into the conversation. Jan, I want to start with you. Goldman's forecast a few weeks ago projected nearly 7% GDP growth in the US. That would be the highest GDP growth that we've seen since 1984 in America. And before 84, you'd have to go back to 1955 and the post-war boom. So just as a baseline, could you walk us through the team's thinking?
Sure thing. Thank you very much. Thanks, Josh. I'm pleased to be here with you, Kathy, and welcome everybody. So we do have a very optimistic forecast for 2021. We've had a very optimistic forecast basically since the March, April timeframe, the early pandemic, that we'd get a strong rebound in 2021 and have generally been far above the vast majority of other forecasters, including the Fed, the IMF, and the private sector consensus. Right now, if you just look on your Bloomberg screen, type ECFC, you'll see that our forecast for 2021 is the highest among 81 forecasters in the survey. There are three key reasons for why we think it will be very strong. Number one, a substantial improvement in the pandemic, and hospitalizations are already down 65% from the peak in early January, and the trend is still downwards despite some wobbles in new cases over the last couple of weeks. Vaccinations are now running at 1.7 million per day on average, and that number is likely to rise to the 3.5 million range in late April, early May. with the approval of the Johnson & Johnson vaccine and increased shipments from Pfizer and Moderna. Our estimate is that if you combine prior infection estimates with the people who've already been vaccinated, allowing for some overlap, we currently have immunity for about 40 to 45% of the population, and we project that to go to 70% in June. So that's going to mean a sizable recovery in the COVID-sensitive sectors of the economy that are still restricted, hospitality, travel, etc. And we think that contributes directly something like 3% to the level of GDP as those sectors reopen. That's number one. Number two is the fiscal boost. And there are different waves of the fiscal boost. Last year, of course, we had a very large amount of fiscal support, especially through the CARES Act. And the combination of those large transfer payments and the fact that spending, at least on services, was depressed, has left pent-up saving on household balance sheets that we estimated about $1.5 trillion as of December. So that's kind of what you came into the year with. On top of that, we had a $900 billion phase 4 package passed in late December with the tax rebates paid out in early January. We're now likely to get a very large package. $1.9 trillion is the ask. It may end up being a little bit less, but it's not going to be far away. We'll find out in the next week or so, and probably will be passed in the next few weeks. And then lastly, there's likely to be a sizable infrastructure package or infrastructure plus package with a headline size of $2 trillion plus. That's probably going to be passed in the summer. There's a lot more uncertainty around that, and it's going to be spread over a much longer period. So the headline number overstates significantly what you're likely to see in the short term. There's also probably going to be a tax offset there, but it is nevertheless likely to be net stimulative. So that's the second driver. Lastly, financial conditions are very, very easy. The Fed's obviously running an extremely expansionary monetary policy that's shown up in our financial conditions index, for example, at the easiest level that we have seen on record going back to the 1990s. And there's been a large easing over the last year. That's the key for the impulse to growth. So that's also helping. So all of that leaves me, I would say, quite confident that we really will see very strong growth this year. There's always uncertainty about the exact numbers, and there's of course some uncertainty in both directions. But I think if anything, the risks to our numbers are on the higher side rather than the lower side. I should say before I close that we do expect quite a sizable slowdown in 2022. 2022 is going to be a lot slower, we think, because the drivers of growth are no longer going to be as supportive. The boost from reopening the economy will be behind you. The economy will be open again, but you're not going to get the same boost to the growth rate. The fiscal impulse will actually be negative in the sense that a lot of the boost in 2021 is more one-off. You're not going to get another round of large tax rebates, and so the fiscal impulse is going to subtract from growth. And then lastly, monetary policy is going to move. The Federal Reserve is likely to be tapering QE, and that could weigh on financial conditions. You're almost certainly not going to get the same kind of impulse from financial conditions, and the impulse may turn more negative. So we do think we'll see a slowdown towards trend growth by the second half of 2022. Now, to be clear, 2022 slowdown is not a bad thing, where we do think the unemployment rate will be back below 4%. The employment to population ratio is going to be much closer to pre-pandemic levels. So you want to see some slowdown in growth in order to prevent what otherwise could be a damaging overheating. But that's our basic outlook. Thanks.
Thank you for that overview of how you get to the 6.9. I think the 2022 point is extremely important and also not usually talked about. Just the headline is the 6.9, the 7. But so Catherine, let me turn to you, for your response, if you see it the same way, both in the US, maybe setting us up globally a little bit. And then also building off Jan's point on QE at the end, we've done analysis here at the council. We know the big central banks have added over 8 trillion to their balance sheets just in 2020. Certainly everyone's talking about that here in the US about tapering. So if you could just comment both on the US outlook and where you see the central bank and the Fed going in the year ahead.
Right. Well, thanks very much for the opportunity to join in this conversation. It is a really fascinating time to be in this business and to view it both from the real side as well as from the financial side. And I think that's a very important direction that we're going to go in our discussion later. So, in comparison to what Jan has been saying and has put forward as the sort of the fundamentals of his forecast, I'm going to put some nuance on this that I think is important. And what the nuance does is it smooths to some extent this boom bust cycle that he sort of has in his overview. Very, very dramatic growth rate in 2021, slowing significantly into 2022. We have similar trajectory, but it's not so dramatic. And here are some of the reasons why. So the first, why we have a sort of a less dramatic cycle in the course of consideration. The first thing is we have to remember the compositional effects that have come not only from COVID itself, but also from the fiscal policy that has been put into place in an environment where there still is rampant COVID around the US economy. And of course, those compositional effects, we're talking about very strong goods demand as people did spend on goods, on housing, on technology, on things to put into your house, a whole range of goods demand, very robust. At the same time, of course, services being locked down. Going into the second half of 2021, we are going to see some rotation. Clearly, as the vaccines are more widespread, we are going to see some rotation away from goods and towards services. But we have to remember that services are not storable. It's not like you can rebuild your supply chain, rebuild your inventories, which was an important component of the rebound in demand on the goods side. You can't do that with services. There will be more robust services in the second half, but a lot of that services demand and the household savings, very robust household savings, that will push into 2022. It won't all be kind of all showing up in 2021. I think a lot of it will be pushed into 2022, maybe because of some supply constraints on the availability of services, but also because there's a range of services that will not yet be back on track. Entertainment, for example, takes a little bit longer to kind of get organized after some of the restrictions are lifted. The supply side of entertainment, for example. The second, so I think this composition rotation issue is the first reason why we have not quite as much of a boom bust cycle as has been suggested by the data coming out, or the survey coming out of Goldman. The second issue is related, and the two of them are related in some sense, is on the vaccines. It's very clear that the discovery of vaccine, extraordinary scientific achievement, but in order to get the changes in economic outcomes that are embodied in a GDP forecast, you have to have a lot of behavioral changes as well. And even after people have gotten the vaccine, and it's a range, we still have a lot of people who need to get a vaccine, and a range of people who say they don't want to get a vaccine. So the issue about consumer behavior, both to get a vaccine as well as to change the behavior towards more service-oriented activities. This is an important feature to get to the economic outcomes that are in the GDP forecast. And again, we think that that is more going to be pushing towards the later part of the year and provide some boost into 2022. On the fiscal side, I think that, Jan has outlined very well the nature of the policy packages and how those have really created a lot of pent up demand and household savings that can be used in the future to support consumer demand going forward. But I do think that this issue, there's this question mark about the infrastructure package and when that might get deployed. And the reason why I question that is that we already have rumblings about fiscal policy being too expansionary. We just put out an outlook last week where we had a survey in there asking about whether or not fiscal policy was too expansionary or not enough. And more than 50% said fiscal policy was too expansionary. So in some sense, I think there's more of a question mark about whether or not we're going to be able to go back to the well again so soon for an infrastructure package, as well as the issue that Jan brought up, which is any deployment of a fiscal policy package on an infrastructure. It really pushes off into 2022, the actual spending associated with that. The last point that I would bring up that I think is particularly important when we think about the prospects for the United States economy is, of course, the international dimension. Which it's a global economy, right? And the United States is still part of it. And when the U.S. has such a robust prospect for 2021, and it has been very goods oriented, what we know is that implies there's going to be a widening of the US trade deficit. We also have to recognize that around the world, basically everybody else is behind the locomotive. The US is going to play the role of the global locomotive again in 2021. And as a result, you're going to have a fair degree of leakage from the fiscal policy efforts to the global economy. It won't be big enough to actually raise substantially the growth rates abroad. What we have is a lot of economies choosing to bolster their international reserves as opposed to move forward with more expansionary policies abroad, particularly Europe. I think we'll be talking a little bit more about Europe later, but Europe is in a very different point in the cycle. They have not recovered to the degree that the US has. They do not have the magnitude of spending in the pipeline. They have even greater concerns about fiscal discipline. And so all of that tempers the amount of demand that we're going to be able to see coming from Europe. And China is pursuing a policy that in the end is looking like they're going to not only, of course, be the surplus country that they tend to be, but a widening of the surplus. So the international dimension is going to temper the prospects for US GDP growth. And I think that that's an important ingredient. And then lastly, to kind of put it all together, tourists, right? Tourists are a very important part of the US economy. And until we get some changes in border closures, there's not going to be that sort of support for US hospitality and entertainment. So changing of the sort of a tempering of the cycle because of composition, because of the nature of vaccine and behavioral change, and because of the external dimension.
Thank you, Catherine. I appreciate all of that. And your line on the US as the global locomotive again is wonderful, but with the caveats that you put in, that it may not be enough. I want to talk Europe, I want to talk China, but before we leave the US, Jan, on inflation, on the bond markets, on what we saw over February, March came in like a lion when it comes to the yield curve, and we don't know if it's going to go out like a lamb. So just your thoughts on what's been going on. And I guess the way to frame this question is it really more technical, overdue, or is it something more fundamental? And will the Fed have to say something or do something at their March meeting coming up, like we saw from the Australians this week?
So I'll get to all that. Just one note maybe on what Kathy said about the boom bust cycle. I would actually probably characterize our forecast as more of a bust boom. Bust was last year and the boom is in 2021. But in our forecast, by the end of 2021, there's just less room for additional strong growth. The economy is still going to be doing, I think, fine, but will slow down towards a trend pace. Now, on inflation, I think it's a mixture. We're seeing an increase in the inflation numbers that is, in the short term, largely driven by more one-off factors. We'll probably have a pickup in core PCE inflation from 1.5% to just under 2.5% over the next 3 months. That's driven partly by lapping the very depressed prices of the spring of 2020. It's partly driven by healthcare, which is a very large component of this index and consists in significant part of effectively administered prices. So these are short-term effects. On top of that, you may see some additional short-term effects as the economy reopens from supply constraints in the short term. And I think that could continue to add. So we'll probably spend 2021 above 2%, at least in significant part, in the core inflation numbers. We do have core inflation go back below 2% next year. Again, there's probably still going to be some noise in the statistics. The short term, I don't think it's going to be all that meaningful in terms of what the underlying inflation pressure is. I think underlying inflation pressure over time is going to pick up, but I think it's going to be gradual. We learned in the last cycle and the cycle before that it takes quite a lot to get to 2% and above 2% on a sustained basis. You do need quite a tight labor market. That's the Fed's goal. They want to get above 2%, but I think it's going to take a few years. And so therefore, I think the exit from the very easy monetary policy that we're currently seeing is also going to be gradual. We're expecting tapering of QE in early 2022, could be late 2021. I don't think it's imminent. I don't think it's in the next couple of quarters, but it could be late 2021. And then I think it's going to take a while, a year and a half, before the tapering process has been completed. And that takes you into 2023, maybe middle of 2023, before you could start to see rate increases. Our forecast is early 2024, but that could move forward. So I think right now, markets, it makes perfect sense that bond yields are increasing. And the trend in longer term bond yields, I think, is going to continue to be higher. I think at the shorter end of the yield curve, markets have probably overshot somewhat relative to what I think is most likely to happen to the funds rate. I don't think we'll see a hike in 2022, and even early 2023 strikes me as quite early. That's what markets are pricing at this point. In terms of what the Fed's going to do about it, I mean, I think they'll probably clarify further, that continue to say to a large extent, they've already been doing this, of course, maybe they'll say it a little bit more strongly, that it will take a while before this entire process has played out. I don't think they're going to give calendar guidance, but they will emphasize this. I don't think that they're going to do anything very aggressive. I mean, actually changing QE, increasing QE, lengthening the maturities, doing something more tangible along the lines of what we've seen in Australia, for example, I think is pretty unlikely, partly because things are actually going pretty well. Financial conditions are still very easy despite the increase in interest rates. And so I don't think they feel the same degree of urgency that maybe market participants who are trading the bond markets or other financial markets on a day-to-day basis are perhaps feeling at times.
Thanks.
So let me,
Catherine?
let me respond on a couple of those things. I agree that we've got a situation where there's going to be a spike in Q2 just by arithmetic, the year over year. We definitely have some input categories that are going to be stronger. We've got a services rebound. But when we talk about inflation, where does it come from? It comes from systematic, sustained, broad-based ability of companies to raise prices. I mean, that's where inflation comes from, right? Do firms systematically have pricing power, whether it's a good or a service? And it's got to be broad-based. And so, yeah, you're going to be able to certainly see pockets of higher prices. And I think that is what the markets are focused on right now, is that they see these pockets of higher prices, especially on metals, certainly on commodities side, and some of the prices of some of the products and some of the goods. But you need to have the broad-based price increases systematically, and more than just a one-off. It's got to be systematic. It's got to be sustained. So when we think about the inflation process, we have put it into different components. One is inflation expectations. One is commodity prices. And then the last component is tightness in labor and product markets. And we can look at each one of these elements and determine the extent to which it is an important driver of sustained inflation. We still have inflation very well anchored. If anything, it's anchored, below 2%, not at 2%. Commodities, everybody has been focused on metals, very strong metals index. But on the oil side, after a price increase, we're not going to be looking at a sustained, through the roof type of sustained increase, because there's a lot more technological discipline in the oil markets than there was 20 years or more ago. And then we get to really the essential components, which is tightness in labor and product markets. We got to remember back when the U.S. had a 3.5% unemployment rate. First, we did not see sustained wage pressures. It was still in that period of time when we were looking at a flat wage Phillips curve. Yes, there were some rising wages, but not across the board. And then finally, we get to this last category, which is tightness in product markets. In other words, do firms have pricing power? We ask around our colleagues who are in those markets and in those equities on a regular basis to ask the companies, do you have pricing power? Do you have pricing power? And by and large, they say no. And there are structural reasons why they do not have pricing power. I mean, there's a lot more price discovery that's available through technological means and out there in the marketplace. And again, I come back to the international dimension of this, which is that around the world, there is still not strong demand. In fact, when we look at our base case for global growth, it never has a boom. It doesn't look like the US at all. It kind of gradually ekes its way back to, by 2024, to the pre-COVID trend in global GDP. So there is no recovery. There's only just a gradual coming up to kissing the previous trend from the lower layer.
So Jan, when talking about the Eurozone, Catherine brought it up originally, and I just wanted you both to comment before we get into the questions from the audience here. Of course, we know it's going to be weaker growth. I wonder if you can unpack that a little, and maybe some of the nuance within the Eurozone itself, and what the southern parts of the Eurozone versus the northern parts of the Eurozone look like.
Clearly, the outlook for Eurozone and Europe more broadly isn't as positive as in the US, because you don't have policy nearly as proactive. You don't have the same kind of stimulus from fiscal policy for sure. There is, of course, the next gen fund, and there is, I think there's been a rethinking in Europe on fiscal policy. And monetary policy, I think, is also going to continue to be more supportive than was the case, at least in the pre-Draghi period. But it's not the same kind of boost that you're seeing in the US, especially on fiscal, and to a lesser degree on monetary policy as well. Having said that, I do think that the growth outlook in Europe is quite strong as well. We're also above the consensus. Consensus forecast there is a little over 4% for the euro area as a whole. We're at a little over 5%. And it's basically because the coronavirus improvement is likely to be visible in Europe as well. They're lagging behind on vaccinations for sure. And there is a gap. I think that gap is going to shrink though over time when we look at the point at which we get to 60 or 70% of the population being immune from either vaccinations or prior infection. Maybe that's lagging behind the US by a month or two, but we're still getting there. I think we're from, and this is obviously based on what the medical experts are saying. I'm not a medical expert, but I do think we're going to be moving into a vaccine abundant environment, and Europe is going to benefit from that as well. There's one other point, which is a simple arithmetic one, and that is that Europe in many cases is more depressed. Output is further away from potential than it is in the US. The service sectors of European economies are generally quite a bit more shut down than the US service sector. So you can also get a bigger bounce in as the economy reopens. Now, that means you're still probably by the end of the year further away from a normal level of activity. The output gap in the US will have shrunk probably under our forecast quite sharply by the end of the year, and will next year be probably mostly closed. But in Europe, there's still going to be more room. Having said that, I think the primary driver of global economic recovery is that we are getting on top of the virus with the help of these vaccines. And I think that's going to be beneficial, not just in the US, but much more broadly.
Thanks, Jan. I think that's really helpful because we measure it by monetary policy and fiscal stimulus, but vaccine stimulus is a type of stimulus as well that we're not as used to factoring in. So, Catherine, I'm curious for your thoughts on the backloading of the deal and the money that's coming out in 2022 versus 2021. And then I want to move on to China, and we're getting a lot of questions on that. So we'll do that in the audience questions after we touch on Europe.
Okay. So, there are three tools of fiscal policy. One tool is tax, one tool is spending, and one tool is rules and regulations. And it's when the three of those work collectively that you get a private sector response, which in the end is what we're looking for when we're talking about a stimulus program. So far, most of the effort that's been done in the United States and actually in Europe as well, different ways of doing it, but it's all been life preservers. Appropriately so, replacing income, replacing revenues. If you're in the case of a business, it's done with actual expenditure, direct payments in the U.S. It's done with furlough schemes and sundry other things in Europe, broader social safety net approach. But nevertheless, this is not stimulative. It really isn't. And we need to be looking at something that has these bigger multipliers, that is not just a demand side, but also a supply side element, particularly important in Europe. We were talking about it a little bit in the context of the US and the infrastructure program. We didn't go into that in too much depth, but we could later. So, I think the point about the next gen was designed to really combine these three tools and say, look, we're setting out a framework that's got rules and regulations on network industries and climate. We're going to follow that up with some money, but we want you to see the total pathway, you meaning the private sector, and so that you will invest into it. The problem is that in an environment of the COVID crisis, it's hard to invest into anything. Even if you have the view, climate's going to be very important. I want to be there with new investments when the complementary public funding comes in. It's very hard for a business to be thinking about that right now. And so the problem with NextGen is it didn't have enough of the life preserver to then marry to the next gen funding. I think that's one of the key challenges that has not yet been kind of dealt with in the context of Europe. We do have Europe coming back more strongly in 2022, so that the 2022 profile of our growth prospects, we look at it in terms of standard deviations from historical experience. We think that's a better way of thinking about these things than just looking at the raw growth rates. That Europe will outperform the US in 2022. And so some of these topics that we were talking about with regard to the international aspect, change partners, who's going first, who's going second in terms of the 2021 versus 2022.
So let's transition from that to China, where we have so many questions coming in. And Jan, I'll turn to you first, and then Catherine. And I think I'll try to package a few of these questions together and frame it like this. Obviously, China, secured the virus more quickly, recovered more quickly in 2020, put them in a strong position for 21. But are there risks on China right now, maybe missing expectations a little bit below their pre-COVID trends? And where do you factor in what's happening on supply chains as a risk to China? Semiconductor shortages, what's happening in container shipment. Is that a risk you're factoring in when you look at China's outlook for 2021?
I think the main point about China is that unlike virtually every other major economy in the world, there is no output gap to fill. I mean, China is basically at the pre-crisis trend, so you're not going to get the sort of boost just from catch-up that we're seeing in the US, we're going to see in Europe, we're going to see across most of the emerging economies other than China as well. A little bit more delayed, but it will come. In China, we're effectively at the pre-crisis trend, or only marginally below. So I think that doesn't give you the same kind of room for cyclical growth. Still going to look pretty strong. I think from an annual average perspective in 2021, again, that's arithmetic because you're comparing with a 2020 that in the early part of the year was also quite depressed. So I think it's going to be an 8% growth rate on paper, but our forecast there is actually a touch below the consensus. And there are some, I think, headwinds that are maybe more noticeable in a place where you're not getting this kind of catch-up growth, and some of the supply chain issues maybe in that category. The ones that we've looked at more are really the financial imbalances that have built up, and the fact that that total social financing, a broad measure of credit growth, is still running about 13%. China is running a very large augmented budget deficit. So the policymakers, who are obviously less focused in China on bringing output back than they are elsewhere, because output isn't so depressed, are more focused on making sure that the financial imbalances don't grow from here, and that perhaps the very permissive lending environment is gradually being pared back. And that's probably also a bit of a short-term downside risk to growth.
Okay, thanks for that, Jan. And Catherine, your take on that, and then maybe widening out too, because we have a lot of questions on other EMs and any hotspots you'd flag.
Yeah, I basically have, we basically have the same story there. China is searching for that way to cross the bridge to the other side, where they have a more balanced growth pattern and production pattern for domestic demand on the consumer side. So, they've not been able to make that transition in the past. And so it's a rocky road this time around as well. Again, when we look at our standard deviation measures, we have China actually operating at about 1.5 standard deviations from their 20-year historical experience off through the forecast horizon. So whether or not they're going to be able to handle that slowdown, moderation, appropriate moderation in growth, I think this is the question mark. It's been a challenge in the past, and it's a challenge going forward.
So, as we move on from China, and I'm looking at the questions coming in now, I wonder if we could touch a little bit on, and there's a question from our senior fellow, Nicole Golden, back on the US. And, not just, you talk about nearly 7% growth, Jan, but who will be the beneficiaries of that growth in the US? Obviously, women and minorities been hit particularly hard by COVID. And so we're wondering some of the investments that will come either through this Biden bill, and then we can move on to the infrastructure and the green climate part of it. Who would be the beneficiaries of 7% growth? What would that employment picture look like at the end of 2021 going into 2022?
Oh, I do think it should benefit women and minorities probably disproportionately, because that's where the hit has been the largest. The service, if you look at it across the different industries, the service sector is still deeply depressed in some areas, whereas the goods sector is effectively, if not at the previous trend line, then certainly at the previous level or above the previous level. So there's not a lot of room there. So it's more the service sector, and that is really benefiting, I think women and minorities to a greater extent. I think the climate investments, that's a much slower kind of path. So now we're really moving mostly certainly beyond the 2021 kind of path, at least as far as government sponsored or government incentivized investments are concerned. And it's this is a 5, 10, 20-year kind of horizon. And I don't think that that's going to show up that strongly in the near term, ups and downs of the GDP numbers that we've looked into. But it will provide a source of support, I think, for the economy. It'll add to overall capital spending over the next several decades. And I mean, the numbers are highly uncertain, but perhaps to the tune of 1 or 2% of GDP, which doesn't sound like a lot, but actually is a very large number if you accumulate it over decades.
Differ a little bit in terms of where I think a potential climate role could play. There is adaptation and mitigation, things like solar panels on the roofs and extra insulation and so forth. This is very labor intensive. So the potential is for that, if in fact an infrastructure package includes that type of components, this is actually very short-term labor-intensive work that could be supportive of the employment going forward. But I think one of the important equilibrators and improvements in the income of the coming out of these two bills, if they actually get both of them passed, is the issue about the minimum wage. Yes, the jobs may come back in leisure and hospitality. They have been disproportionately lost for women and minorities. But you get those jobs back and they are at the same low wages. That doesn't really represent all that much of an improvement. It's that wasn't a great economy for that part of the income distribution. And we'd like to come back to a better economy at the end of this. And so the minimum wage aspect, I think, was a very important one. We don't know where that's going to end up. But I do think it's important to note that more than 20 states have taken state level initiatives. It was ballot initiatives by the people in those states to raise their minimum wages pretty substantially over the timetable that is currently was under consideration for the $15 minimum wage. Now, there are differences in different areas of the country. Obviously, that is true. But as I say, I think it's important to note just how widespread the demand at the state level through the ballot box, that the individuals who would be paying the extra, whether it's for a restaurant or whatever, and the businesses that would be also having to pay that for their workers, that this is very broad-based support for higher minimum wages. And of course, that is also going to be if it were to be passed in some form or another, would disproportionately improve the impact of the recovery on the types of workers who have been disproportionately hurt by COVID.
Thanks for bringing that part of the conversation in, because I think this will just be the continuing debate in the fiscal side, even after this first Biden bill and whatever happens in the second one. The minimum wage issue is not going away anytime soon. I have a question here on emerging markets, and it's based on what the IMF had said. So, the IMF's called this a divergence in 2021. Obviously, we've been in the world moving towards convergence with catch up between EMs and developing countries and advanced economies. At least half of those will now move further away from the advanced economies in 2021. So, Catherine, maybe just sticking with you here and then to Jan, are there particular countries you're concerned about? What is the risk of this sort of divergence over a decade-long time frame? And will the IMF's, the special drawing rights that might get approved, will that help at all? Is that not enough? Are we looking at debt defaults in 2021 and beyond in some of these places?
Pretty big package of questions. So let me start by saying that, that convergence had slowed down and had been derailed more than 10 years ago because of the slowdown in globalization. That has always been a very important ingredient for the powering of the convergence of the emerging markets. And with the flatlining of globalization more than 10 years ago, we already had a situation where convergence was off track. So COVID, of course, made it even worse. And I think the way to think about it, though, is within emerging markets, there is tremendous dispersion. There is a K-shaped recovery for emerging markets as well. If you're an emerging market that is technology intensive or certain types of commodity intensive, then you're actually coming out of this doing pretty well. If you're an emerging market that is tourism intensive, or has been challenged in particular by responding to COVID, you are not doing as well. So there's a very big difference within emerging markets. You really shouldn't lump them all together. They shouldn't even be lumped together by region, because even within regions, there's dispersion in performers who are doing well and performers who are not. The second point, though, emerging markets is the extent to which they actually have taken policy space. They have used the policy space that they had with more fiscal expenditures, with more central bank, having central bank discipline to reduce interest rates. So we may argue that there wasn't enough space, they haven't been able to use as much policy, but they did actually use a lot. And the question going forward now is to ensure that the policy, that they don't have to ricochet back. They don't have to ricochet back to tight monetary, tight fiscal before the COVID situation is under control and before the global economy is back in a position of providing some support. And the SDRs could play a role in making that bridge. The last point on the emerging markets is, I think we have to recognize, and this is part of the kind of subdued picture that we have for emerging markets, is that many of them are being very disciplined about their external balances. They're looking to increase their international reserves and to ensure that they have the type of insurance policies through international reserves that we know that the financial markets often demand that they do have.
Thanks for that. I think, your point about K-shaped recovery from emerging markets is so important in the way we describe about it based on their own economies. And so, Jan, just turning to you on that question, things you're watching for in EMs, and also just on this QE point, emerging markets have taken a different tact in monetary policy than I think we've seen before in this crisis. And are there risks of that going forward as they try to remain expansive and supportive, but also just don't have the capabilities of a Federal Reserve or an ECB?
Yeah, I'd say there are certainly significant differences. I mean, we discussed China. China is an outlier in terms of where they are currently relative to trend and what that leaves in terms of room for recovery. I would say at the other end of the spectrum, you have India. India saw the biggest drop in GDP of all major economies in the second quarter. They're coming out of it and the situation is improving. I think there's still substantial room for growth. So we think that India is probably going to outperform consensus forecasts quite sharply, we think by several percentage points. I think, emerging markets is a very wide category of economies, but in general, I do think there's substantial catch-up potential in a number of them, and it will take longer because the vaccine rollout is going to take longer. But as you get into late 2021, early 2022, I think we'll also get to very high rates of vaccination and overall immunity that should restore activity in those sectors that are still depressed, including tourism. It's not going to be overnight, but I do think that having large tourism exposure obviously has been a big liability and will, still be a liability in the short term, but eventually it's going to turn into more of an asset. On the monetary policy side, clearly there is a range of central banks. There's an ordering of central banks. The Fed has the greatest degree of flexibility. Other advanced economy central banks can also do a lot, maybe not quite as much as the Fed, but also can do a lot. Emerging market central banks are always operating under tighter constraints. However, I think what we found in this crisis is that emerging market central banks actually were able to support activity by quite a bit more than was the case in past cycles. So I would take a reasonably positive view of the stabilizing function that central banks across the emerging world have been able to play. And that's been a reason for why things, I think, in terms of financial market developments and real economic developments, at least in some places, didn't turn out to be as negative as perhaps was expected in the spring and summer of last year. There are always risks if we do get further upward pressure on US interest rates once the Fed really does move towards tighter policy. I think that is going to be a difficult environment for emerging market central banks to navigate. There's always the risk of more transmission of negative financial conditions shocks. Perhaps the US will have fully recovered at some point, over the next year or two, but it still takes longer in EM, and then a contractionary impulse is transmitted from the Fed. That's definitely something that policymakers are going to have to be nimble about, and that could present challenges for sure.
So then taking your point there about what the Fed does and how that spillovers to the EMs, I want to take a question here on central bank digital currencies, because that works the other way. The innovation there has not really come from the Fed and the ECB. It's come from Asia. It's come from other EMs in Africa, actually, on financial inclusion and fintech. And so, Catherine, I'll ask you, I know both of you work for private banks. I understand that, but I'm curious, your thoughts on central bank digital currencies, what that means for an economy like the US, a digital dollar, and what that means for monetary policy transmission. And is this something where we're going to see movement now based on Secretary Yellen and Chair Powell's comments last week?
I think it's always important to make a distinction between a digital currency as a payments mechanism and a digital currency as a replacement for whatever the currency is out there now. The physical unit. And I think these two get conflated with each other. And I think it's important to think about them separately, because there is a difference between, a strategy or a fintech or whatever that is designed to improve the payments mechanism. There's certainly some arguments for some improvements in the payments mechanisms. The replacement of the digital dollar or a central bank digital currency as a replacement for the current dollar, and many people think about this not only in the context of the U.S., but of course in the context of international reserve currency as well. Is the issue here is how much do you want to disintermediate the financial sector? Do you think it plays a role? And if it plays an important role in the transmission mechanism of monetary policy through the financial sector onto real economic outcomes, then thinking about what potential disintermediation a central bank digital currency might play, that's an important part of the discussion about what one should do. And that in terms of supporting it or having a parallel digital aspect to it. So as again, payments mechanism is one question. Replacement of the physical currency, obviously another one. And then this third one, which I think is really where the bulk of the consideration is if you think the financial sector and the banking sector plays a very important role in the transmission mechanism of monetary policy to the real economy, then you have to worry about disintermediation. It's not a new question, by the way. This issue about disintermediation of the regulated component of the financial sector, this is not a new question. It comes up a lot. And the central bank digital currency is just the sort of the new flavor of that question.
Thank you. Thank you for that. Okay, so we have a few minutes left, and I'll ask one concluding question here. And Jan, I'll start with you and with Catherine. So it just seems, I'm thinking back of my experience in 2009 and the global financial crisis. It seems like, the US in particular has changed so much in 10 years in the way it's approached this crisis by 10, 12 years ago. And thinking of US GDP, fiscal spending is going to be over 20% after this current legislation. And so I'm wondering from you, Jan, and then Catherine, just what lessons have we learned as a global economy in the last 12 years? What is different now in the debates we're having and the policy, and trying to set forward not just the path for 2021, but what the 2020s might look like, given what we learned from the last crisis?
I think, and we each have 1.5 minutes to discuss this, but no, I think it's obviously a very important question. I mean, I think the world has learned that in a big crisis, it makes sense to take decisive policy action and more counter-cyclical policies, both on monetary and on fiscal policy, that you can do that when there is a lot of room. The risks of excessive inflation or fiscal crises that I think many people were overly obsessed about in the 2008 crisis and the years that followed. I think there's been a healthy rethinking of that. And so policymakers everywhere, or in most places, have just been a lot more proactive. And there's still a hierarchy of proactiveness, and that hierarchy doesn't look very different if you just look at the ordinal kind of ranking, but everybody has moved in the direction of greater support. So I think that's one important difference. The other difference, of course, is it's a totally different crisis. This is driven by us shutting down parts of the economy in order to get on top of a pandemic. And then once we get on top of the health emergency, we can bring activity back much more quickly. The previous crisis was driven by the bursting of an asset and credit bubble, which of course just takes longer to solve.
Okay, Catherine, I'll give you the last word.
Big crisis, go big, go quick. We've done that. What is going forward, I think, is the exit. How does one exit from the very significant policies that had to be undertaken in order to combat the pandemic? And in this regard, I think the biggest challenge is that the extent of liquidity in the financial system is so great that how one moves monetary and fiscal policy through this very, very liquid financial system, how one sort of tamps the brakes down a little bit when this very liquid financial system tends to overshoot. And then how much that transitions, that overshooting, which may cause a problem, affects the real economy. That is the biggest question going forward. It's a dilemma for the central banks. It's not a new dilemma, but it is a bigger dilemma than before. It's also now partnering with the fiscal authorities.
Thank you. So we'll make that the final word. Jan, Catherine, thank you so much for joining us for this conversation. I hope we can have you back later in the year so we can judge the forecast. We won't be cruel about it. We'll be forgiving, but we'll see where things stand maybe 6 months from now. And we want to thank everyone for joining today and participating. We're going to continue to talk about this, of course, at the Geoeconomic Center, events coming later this month on trade, the Biden National Security Plan, the supply chains issues. So please stay with us and have a great day, everyone.